Thank you everyone for joining. We will kick things off by obviously introducing what we will be discussing today, which is the do's and don'ts in the first year of business. We've really been focusing on a campaign across all of March that we've entitled Marching Forward. And really that the purpose of Marching Forward is to help businesses within those early stages, businesses that are typically it's their first business, they're maybe a little bit less experienced in the ins and outs of what goes into operating and running a business, and helping out with just a few tips and tricks that experts have found along the way. And I can safely say that everyone's in very, very good hands here. This is literally all that Damin and Pat do, is advising businesses, and particularly businesses in early stages. So I will let both of our speakers introduce themselves as we get into their content. But today's agenda, it looks like this. We're going to be talking through business structures, what they mean for you, what's going to be the best type of business structure for your business when starting out, but also something that you might want to retrospectively change if you feel the need to do so. Legal considerations that come into your first year of business. Damin deals with literally thousands of businesses every year through our legal advice plan who are asking questions. There's very common trends that come up in the questions that are coming through, and it's exactly the same as what we see on the accounting side of things. And there's a few things that we can really help try to guide you with along the way that are going to really help you to save time and a heap of money in the long run as well, and also mean that you don't find yourself in a sticky situation down the track. We're going to talk through ASIC and ATO obligations, and then leave plenty of time for Q&A. And we've got a special exclusive offer for those of us who are attending on the webinar today. Just a bit of housekeeping before we get into the presentation as well, that we would ask that everybody who has a question, because the chat gets flooded as we go through our presentation, we'd really appreciate it if people could leave their questions in the Q&A section as opposed to leaving them in the chat. That means that they'll stay there. We'll be able to answer them as we feel that the content is relevant, or at the end if we don't get to that time. So if you have a question that is pressing, you want to get answered, we'll do our best to do it if you're leaving it in the Q&A. And a final piece, so we are your hosts today, Lawpath. For those of you who are less familiar with what we do and have come through from our partners and from our wider network, we are really geared to help businesses from day one in being able to start and run their business, keep compliant, and be able to do this at a fraction of the time and the cost of the traditional system. So we offer a range of different services through our platform: unlimited access to legal and business documents to be able to create and sign online, on-demand access to being able to speak to lawyers as part of our advice plans, and the ability to hire lawyers through a lawyer marketplace, and also handling all of the registrations, which I'm sure a lot of the people that are tuning in today have come across us through the fact that they've registered their company, their ABN, their business name through our service as well. So, we're helping businesses with this every day, and we really look forward to taking you through this content. And without further ado, I'm going to pass on to our first speaker, Damin, to go through the legal side of things. Damin, over to you.
Thank you very much, Tom. I guess we just begin. What we're going to do is we're going to get into the corporate structuring. My name is Damin Murdock. I'm the legal practice director of Lawpath Legal. I've been practicing for more than a decade. I've participated in a lot of very large, complex litigation matters, regularly act in capital raising, done millions and millions of dollars of capital raising and structuring and deals. And so we've worked with from the smallest company that just started yesterday to listed companies. And so I should be able to answer pretty much all your questions, unless they're tax related, and they're going to be deferred over to Pat. And I guess we just jump straight in.
Yeah, absolutely. We have to start on business structures before I pass on to Damin, and we have another poll that we're just going to launch. And this poll, oops, one moment. And this poll is going to cover all things around the business structure, which is really going to help Damin as we go into this content. So All right, Damin, take it away.
Okay, you just started. All right, so a lot of people want to know what kind of structure they should have, and it's not always apparent what structure they should have. And I'd like to work with accountants normally in choosing what structure to go with. Sometimes you want to just keep it really simple. So when you look at a sole trader, oftentimes if you're just doing a proof of concept, if you have a small business and you're going to make less than $75,000 a year, and maybe you're doing landscaping, maybe you're doing art, something along those lines, and the risk isn't very high, then sole trader is a very simple structure. It's one set of tax returns for you and your business. You can still have a trading name, so you can still call it Lily's Landscaping or something like that, but it's a really simple structure. But it's not easy to raise capital. It's not easy to bring in business partners. It's not easy to mitigate your risk. And when you start getting more complex and becoming a larger business, we generally recommend you go straight to a company. In terms of partnerships, it's a fairly old structure. The Corporations Act was 2001. The Partnership Act is on a state base, but most of it's written in the 70s. And it's really primarily used for accounting practices in law firms, where the partners are going in together and they can divide the income between themselves. But again, it doesn't have that limited liability that a company would have. It doesn't have that easy way to do governance. So Corporations Act is one of the most comprehensive legislations in the world. It deals with most scenarios, whereas the Partnership Act doesn't. And so when you have a dispute, it's much better to be able to rely upon the Corporations Act than go into the partnerships legislation. And so we generally just don't recommend it. Do you?
No, it's similar. And it depends, like it is common practice for accountants and lawyers to do partnership models. And I think where you're trying to split income, it kind of locks in the income split, but there's other means to do so. And the risks, as you mentioned, like being liable for the other partner as well, that's something that
that's right.
Something else to consider. You could be liable for the other partner's actions. So it's just important to make sure that you've spoke to your lawyer and you've got your agreements in place if you go down that route, because it is high risk.
It's not that common. Some accountants still recommend it sometimes. And I guess that would depend on the industry you're in. Normally it's professional services. But then you have the company. The company structure is an old principle, Solomon v. Solomon, one of the most notorious cases out there, established that it's a separate legal entity. So if the company does something wrong, you can't go against the directors personally. You can't go against the employees personally normally. There's obviously some exemptions to that. And in those exemptions is trading insolvent. So where a company might incur debts when they know they can't pay those debts, that's insolvent trading. The directors can be personally liable. Or maybe someone is a director and they sell the world to somebody. They make all these representations. They say they act for all these blue chip companies. They have all these testimonials on their website that's fake, and they don't act for them. And that would be misleading and deceptive conduct. In those situations, normally a lawyer would try to go after the director personally for that. But it's fairly rare. And normally they're just going after the company assets. And with the company, you have a lot of huge growth opportunities because you can sell shares, bring in new shareholders, and it just gives you a lot of flexibility.
Great for tax too.
And great for tax. You can expense things through it. You can pay dividends to yourself. If you're the shareholder, you can pay director fees to yourself. If you don't want to pay super, you can pay yourself as an employee as well.
Employee shares.
You can give employee shares in the business. So there's just a lot of different share classes. So some have non-voting rights, some have other voting rights. If you have two business partners and you're in a service and you want to create it whereby those partners are getting dividends for the work that they're doing. So rather than just paying the same dividends across the board, you can create different class of dividends, and you can pay off each partner or director a different amount by way of dividends. And then you get trusts and trading trusts. A lot of accountants will set up a family trust, create a corporate trustee, and then the business will trade as a trading trust. I don't get it.
I don't either, because the company tax rate is the best tax rate going. And the problem with the trust structure is once you distribute the income, it can be classed as passive income because it's a distribution, and the tax rate is 30%. And it's also important, there's been a lot of changes around the family trust recently around distributing income and how that works. And there's a lot of issues with retrospective where they're not grandfathering certain things. So unfortunately, trusts at the moment are under attack, and there's a fair bit going on. So yeah, I definitely agree. I think a company is by far the best structure. And given you have the different share classes, you can still get to the same outcomes of.
Yeah.
But then you could have family trusts as a shareholder as well, discretionary trusts.
So we often see a trading trust, which is a trust with a corporate trustee that act on its behalf. And in those situations, it doesn't give any asset protection at all, because the trustee company indemnifies the people that they're entering into contracts with against the assets of the trust. So if you have a trading trust, which means you have a trust with a corporate trustee that's actually entering into your contracts, you actually have no asset protection at all. And I don't understand that structure. You actually need to have one more company above that, and you need to make your corporate trustee a shareholder of the trading company so that your assets are one step removed. Some of this, if you guys are just starting business, you're 12 months in, it might be a little bit over your head at the moment. You might don't know anything about trusts. So don't worry about it. There are videos on Lawpath's YouTube channel explaining what a trust is. There's a bunch of articles on it. If you're on the legal advice plan, you can simply call and ask, can you explain to me what a trust is and how that works and whether I should have one? And then the next one is looking at the corporate group. And the corporate group is essentially where you start getting into a little bit more sophisticated structures. And I guess the standard structure that you normally see for businesses that are a little bit more advanced is the main shareholders will create a family trust. That family trust, or the trustee of that family trust, will then own all the shares in a holding company. That holding company will then have all the intellectual property and the assets. Could be a warehouse, it could be your intellectual property, your software, could be machinery, whatever it is, all the assets are there. And then those assets are then licensed down to a trading company. And that trading company is actually solely owned by the holding company. So the holding company has all these shares in that trading company as well. Now, the reason why you do that is when you're trading, you're entering into possible liability. You have employees, maybe, you're entering into large contracts. You could enter into a contract and default under that contract. There could be a lawsuit. Your insurance might not cover it. If you have insurance, it does cover that. It might not be large enough. And so you might need an opportunity to basically cut off your trading company, and you basically exit. You gut it from, you take all the machinery, all the IP and all of the cash and everything that's in it, and you gut it and you pull it up to the holding company and you leave the trading company empty. And that's essentially allowed. And that's because you have what's called a license agreement, where you've licensed down your IP or your technology or your machinery down to your trading company and lodged a PPSR. I can't emphasize how important that is. So if you did have a problem with your trading company and it was sued, a liquidator could be appointed. And when a liquidator is appointed, they can go in and look at all the assets. They take control of the bank accounts, take control of the whole company. And then the unsecured creditors essentially can direct the liquidator what to do. if there's money in that company, and the liquidator can go and take votes and determine what the next steps will be. Now, if you're a related party, your votes don't count. If you're a related party, it's possible that your transactions with that trading company aren't recognized, because a liquidator doesn't have to recognize related party transactions or votes unless you are a secured creditor. And the way you become a secured creditor is having a license agreement that contains a PPSR, which is a personal property security register or registration, and you've lodged that registration with the PPSR. So I normally explain what it is you buy a car, you get finance on your car. When you go sell your car and someone can actually do a PPSR search and see that the financier has a charge against that car. So you can't necessarily sell it without discharging that debt. That's the same with this. You license your IP down to your trading company. Something happens to the trading company, you terminate the license agreement, you pull up all your assets. But if you don't get a chance to do that before the liquidator comes in, you're still the number one secured creditor, and the PPSR defeats the liquidator. So you have to have that PPSR registration to have your protection when it's a related party transaction. And it's a license agreement for technology and equipment. It's a loan agreement or facility agreement with the PPSR when it's cash coming down from the holding company to the trading company. Now, when you're just starting out, there's certain contracts that you normally want to get in place, and there's certain things that you want to make sure you have. So one is looking at your terms of service, and you might start off with basic terms, and you'll find your pain points later on. You'll find out that a client's not paying you, and it's probably because your terms aren't strong enough or your terms aren't crystal clear. A shareholders agreement, and we'll talk about vested conditions, founders' rights, and then we have the different insurances, whether you're going to be employing employee or contractor, and then looking at your website legals. So looking at the shareholders agreement, the first thing is that if you have 3 shareholders, for instance, who have gone in, they're each a founder, one CTO, one CEO, one COO, and they all are getting shares, 33% each, because they're working in the business. Well, what happens if someone gets hit by a bus tomorrow? So you just incorporated your company, one of them got hit by a bus. You now have someone holding 33% shares in your business for the next decade, for the next 10 years.
Or they leave.
or they quit. The company's not actually getting off the ground as quick as they thought they could. They've just got a great job offer from a top tier company. They decided to leave and go do that. They have 33% of your business. Very rarely will a sophisticated investor ever invest into a company where the 33% shareholder of the business isn't in the business, isn't working in the business, or hasn't contributed significantly to that business, or hasn't paid for it. So we highly, highly recommend having vesting conditions where you're giving someone shares for essentially free, or shares for on the condition that they're going to be working in the business. And reverse vesting is basically a clause in the shareholders agreement. It says, we're giving you these shares now. You have all the voting rights that you normally have. You have the right to appoint a director like you normally would have. You get the dividends like you normally have. However, you've got to work in the business for the next 4 years. And there's 12 months per year, which means there's 48 months over the next 4 years. And month on month, you'll slowly earn 1 divided by 48 times the amount of shares that you have, so that month to month, you slowly earn your shares. And if you leave after 24 months, well, you only keep half your shares because you've worked 24 divided by 48 months, and the company can buy back half of your shares. Now, if you don't have that clause, then you could have someone that just quits and there's no real commitment for them to do anything, because you've given them shares. They paid the price, which is probably 0.001 per share. So they paid their $1 for their shares. So you don't have any legal claim to get them back, and you're stuck with it. Founders' rights, we found that they're quite accepted by the large investor VC world. Founders' rights are essentially saying that as long as you hold 5% in the business, you always have a right to appoint a director. And you always have, and they can't have a director's meeting without your presence, can't have a shareholders meeting without your presence. And if there's big decisions like signing a lease, getting a loan, issuing new shares, things like that, then they need your approval as the founder as well before those changes are made. If you do have founders' rights, normally the investor that's coming in, if they're sophisticated, will also want the similar rights, which is fair enough because they're normally putting in a big amount of money and they want similar protections. But we recommend getting founders' rights. And then the next ones are fairly standard, preemptive rights when you're dealing with, when you're about to issue shares, you got to first offer your existing shareholders those shares, or if a shareholder is going to sell their shares, they got to first offer those shares to the existing shareholders. Drag along, tag along rights, that's getting into if you want to sell your business and you have one shareholder who owns 2% of your business and they refuse to sell, you can force them to sell so that you're able to sell the entire business. And normally drag along, tag along rights have saying 25%. So a drag along, you can drag along your disgruntled shareholders and force them that 25% to also sell with the other 75. And tag along says, well, where 50% of the shareholders have sold out, the other 50% can tag along on that deal and make that buyer buy them out as well. But the main clause, the most important one I find is dispute resolution. If you have a dispute regarding your company, 9 times out of 10, you're going to end up in the Supreme Court of your state. That's because the Corporations Act, the primary jurisdiction is the Supreme Court. A filing fee in the Supreme Court is around $3,000. You normally have to have a barrister once you go there. So that's $5,000 a day for fairly, well, it's $3,000 to $10,000 a day for a barrister or a lot more. And it's a very, very costly exercise. So normally you want a dispute resolution clause because it locks you in a room for up to 8 hours. I was in one last night till 9 p.m. And you have to try to nut out a deal. And there's a third person there trying to force you to realize that if you continue on, you're going to have a lot of costs. But the mediator can't make a decision, but they're trying to knock some sense into the parties and say, let's try to resolve this. Let's try to get through this, and doing it for up to 8 hours to try to get a resolution. And that's before anyone goes to court. And it's really important to have one. And then the amendment clause. If you have a bunch of shareholders, you have one shareholder who doesn't agree to amend the shareholders agreement, there's nothing really you can do. So you can put an amendment clause in that says, before they sign it, saying this shareholders agreement can be varied by 85% of the shareholders agreeing to it. That way you can change it and you don't need that one shareholder that's holding out. So have a look, see if yours has it. If not, make that change. Now, looking at terms of service, I've gone into this previously in other presentations, and I obviously need to give Pat an opportunity to talk as well. So the main thing about your terms of services is you're going to feel your pain points eventually when either the clients aren't understanding your terms, you haven't clearly defined your scope of works, you haven't clearly defined what's included or what's excluded in your scope of works. And I act for a lot of builders in building. And I see this a lot of times because a builder will say, all right, you get this, you get what's called a prime cost item, you get, or a provisional sum item, or in the specifications, they'll specify you get this builder's range of white goods or this builder's range of taps and faucets and so on. But that doesn't really mean anything. It doesn't mean anything at all. And clearly the client doesn't know what a builder's range is. So for builders, I say, well, tell them the name of the range, tell them your supplier and what range of goods those are to make it clear. That's just an example for what you're doing. I often have disputes that I'm looking at on my client side and says, oh, well, the services include this, but they don't include that. I said, well, where does it say it doesn't include that? Any reasonable person reading it would probably think that that's included. So it might be in your head that it's not included, but make it clear. Make sure your terms are clear. Spell out the inclusions, spell out the exclusions, spell out the limitations.
Yeah, I think that's a key. Including the exclusions is just as important as putting in what's included, so that there's no ambiguity around what services are getting provided and what is included in the service. And it also allows an opportunity to potentially upsell and create additional products or services.
It does, and it's a great opportunity to break your services into different packages.
Yeah.
So, oh, well, you want that. Oh, well, that's an extra X. Oh, you want unlimited. Well, then that's a total different package. One of the other things that we look at is also a lot of lawyers recently are claiming Section 23 of the ACL. It wasn't that common, but now everybody's claiming it. And that's where you can find that certain clauses in agreement are unenforceable because they're unfair contract terms. And that primarily relates to where you have website terms and conditions that aren't necessarily negotiable. And so if someone just clicks to accept, there is a possibility that those clauses are unenforceable, and primarily in standard form contracts. And your online terms and conditions are standard form contracts. So it is good to put in a clause that says, if you would like any changes to this agreement, please feel free to contact us. We are open to suggestions and we're open to amending our terms and conditions to suit your requirements. But by signing this, it means that you have looked at it, you approve it, and you don't require any changes. And then the reality is no one really reads those online terms anyway. And so you have that as a defense if someone brings up an unfair contracts term clause. Another thing to look at is when you have your general disclaimer, limited warranties saying, I'm not liable for anything, is unenforceable. And that's because you have Australian consumer laws, you have certain guarantees of its service, it's going to be fit for its purpose, it's going to be delivered within a reasonable time, it's going to be, if it's good, it's merchantable quality, it's similar to the sample that's been supplied, and so on. So these are the things that you do have to limit. So you want to make sure your exclusion clause exclude or mentions the Australian consumer law. And if it doesn't, then it's probably an older set of terms that, because these came in 2010. And before that, it was Trade Practices Act. So you just have a look at that. And then the last one is looking at your refund policy, cancellation policy, which I'll talk about in another slide. Quickly on insurances, you've just started out, you might not know, you must have work cover if you have an employee. It's a legal requirement, and you can be personally liable if you don't. Product liability insurance, that's where you're selling a product. If you are importing something from overseas and then selling it here, you're deemed the manufacturer, you're liable for that product. So if that product is defective, you can't just say, oh, well, sue the manufacturer. They can sue you and you're liable. It's then up to you to sue the manufacturer. And so if the manufacturer is overseas, it's important that you have an agreement with them, normally dealing with arbitration. So you're able to get a binding agreement and binding decision against them. And you also want to make sure that manufacturer has product liability insurance as well. So if you're sued, you can sue them, and your insurance is triggered and their insurance is triggered. Professional indemnity insurance is for professional services, generally, marketplaces, any kind of services, and public liability is slip and fall insurance. If you're in control of a site, if you're a builder, if you're in control of a property because you've leased it out, you need public liability insurance. I'm not going to get into the difference between employee and employer or in contractors. Just note that some things to consider is non-solicitation clauses. So they're not, your employee and contractor is not going to solicit away your staff, your contractors, your suppliers, your clients, and so on. And have a look at your notice period, whether you want to do it in accordance with the Fair Work Act or the 4 weeks that a lot of people require. And then Lawpath offers all these templates that you can have a look at in the Lawpath, database in the library. Yeah. And some of the similar questions, or some of the questions I regularly get asked is, Do I need to set up that corporate structure now? The answer is simple as no. A lot of times I say, you can go and prove your concept, but once you start making good revenue, you want to do that restructure right away, or else you have capital gains tax when you sell your shares or sell your assets in doing your restructuring. So you don't have to do it right now. You can prove your concept, but once it is a proven concept, do that restructure right away. Do you require a shareholders agreement? Highly recommended if you have more than one shareholder in your business. How do I make sure I get paid on time? That's going back to your terms and conditions. If you're not getting paid on time, consider taking a deposit, consider getting more enforceable contracts, and make sure your scope of works, your services are spelled out clearly. And make sure you get a software development agreement or web development agreement before you build your website, because a lot of developers will take a lot longer and go way over budget than you anticipate. And it's probably the main dispute that we deal with. And can you terminate your employee? That is always a very specific, detailed advice, but there's two things that you should know. There's something called an unfair dismissal, Fair Work Act. If you're a small business, less than 15 employees, they can bring a claim after they've been employed for 12 months. And general protection. Someone exercises a workplace right. As a result of that, you've terminated them or treated them differently. So I have a right not to be bullied. I've made a complaint for being bullied. I've now been terminated. Any employee can bring a general protection claim, or I have a right to work safely. This is not a safe environment. I make a complaint about it, and then they terminate you. Again, example of that. All right, back to Tom.
Fantastic. Thank you, Damin. We've got a lot of questions that have come through for Damin as well, and hopefully a few of those we've been able to get through as part of the content that has been presented, and we'll leave a little bit of time at the end. But before we pass on to Pat, our next presenter, I just wanted to introduce everyone to our legal and accounting advice plan. This is a plan that we've put together in partnership with Pat's company, Pop Business. And where this plan differs from what we have offered on a plan that most of you would have heard about, our legal advice plan, which gives unlimited access to on-demand legal advice and 30-minute consultations with lawyers. Where this plan is different is it also adds the ability to bolt on accounting advice in here as well. And you're getting that through from verified ASIC ATO agents with plenty of runs on the board in dealing with businesses just like yours. And there's also the ability to get preferential pricing on any of the additional legal and accounting work that is being done. It's billed on a flexible payment term, $293 for the month. And make sure that you stay on to the very end of this, because we have an offer that you probably hear people say this a lot, but trust me, you do not want to miss out on this exclusive offer that we're going to be doing as part of this webinar. But without further ado, to get into the accounting and tax sides of your first year of business, Pat, passing the mic to you.
Yeah, thanks, Tom. Yeah, I'm Patrick Sargent. I'm the CEO of Pop Tax and Pop Business. We're a chartered accounting firm based in Sydney. We've been working with Lawpath for some time now, work closely with Damin, and we do a lot of work together with various aspects. So the legal and accounting are very intertwined, and we, whether it's ESOP valuations or employee contractor, we work together a lot on various aspects, capital raising, corporate restructuring is a big one, selling, exactly, setting up family trusts and companies and what's right for business owners. And I've seen a question in the chat regarding changing from a sole trader to a company. It is a relatively simple process, but there are also some considerations if you do have that trading history. So yeah, definitely something you need. There's a few things to consider before you do it. But if your business has got to that point where you've as Damin alluded to, you've proved your proof of concept, then yeah, you should definitely think about it. So yeah, we're a team of chartered accountants. We're based in Sydney.
Really good experience, been advising businesses for, some of the accountants in the business over 20 years, really tech savvy. So we use all the latest technology. We've got an in-house development team. So we also build some products similar to Lawpath, which is sort of why we're quite aligned. And I hope you get some value out of this. If you've got any questions, please add it in the chat. So I know there's a few business owners that are past their 1 year of business. We'll keep it to the first year as much as possible, but also hopefully some of this applies to business owners that have been in business for more than 1 year. I won't spend much time on this one. It's pretty straightforward. You need a separate bank account for your business transactions and your personal transactions. Definitely set up a separate bank. You need to track it separately. This is just the bare basics. You need an accounting software, and you need, there's tons of benefits via having an accounting software. Automatic reconciliations, doing your invoicing, accepting payments online, doing your payroll, doing your business activity statements, accounts payable management, automatic reminders for invoices. So there's just so many reasons why you'd have an accounting software. There's a Lawpath have a fantastic offer with MyOb at the moment. So get 6 months free if your business is less than 12 months old, or 50% off if over 12 months. So I'll let Tom share some info around that. There should be a link in the chat for this one. So if you're looking for a software, you might already have Xero, you might already have QuickBooks, you might be looking for a software. This is a really powerful software to use. So we definitely recommend checking it out. Tax and reporting requirements. You need to register for GST if your turnover exceeds $75,000. If you're a not-for-profit, it's $150K. You will need to report on a quarterly basis usually. And just some considerations is cash versus accruals. So do you report when you receive the cash and spend the money, or do you report on an invoice basis? And that largely depends around, are you doing lots of sales and do you have lots of invoices? You don't want to pay GST when you haven't yet received the money. So there is some planning you should do and look into your business model. Are you a point of sale? Do you have purchase invoices? What's more beneficial? It could save you a lot of money from a cash flow perspective. And, first year business, cash flow is king. So you really want to just make sure you're utilizing every little bit of advantage you can. So look into this before you're registering your GST. You can choose to register for GST if your income's below 75K. Some business owners do it. They might get refunds because they got more expenses. They might do it because it looks more, you might win contracts, etc. But typically it's, if you've got some expenses, not much income to start, you want to get those GST credits refunded back. So you might register for GST even if your sales are expected to be less than 75.
What about not getting an ABN? So if it's just a trustee company holding shares in your trading company, what do you say about that?
Yeah, so you don't need to get an ABN. So if it's just holding shares, so Damin showed a structure before, potentially there's a corporate trustee above a trust. It's just acting as trustee. It's not trading. It's not actively doing anything. You don't need an ABN initially until you start needing to use it for a particular reason. So you might not need an ABN.
A lot of people create a company just to hold shares.
Exactly.
And it doesn't actually do anything.
Yeah, or the trust might hold shares as well, and it's dormant effectively. So it might hold some shares and not much is happening. So you might not need an ABN for that yet. So some other considerations: the company tax rates decreased down to 25%, which is great. So we can do some really solid tax planning and utilize this lower tax rate. That's why a company is so good. Marginal individual tax rates go up to 47%. So a company caps that tax, and there's some really good structuring, Damin and myself work on for having the family trust distributing to a bucket company. Family trust being the shareholder of the company, receiving dividends, flowing down to a bucket company, and getting the cash out of your business into a personal sort of structure that you can invest through with your money outside of your business. So yeah, the company tax rates decrease, which is fantastic. If you have employees, you will need to
pay withholding tax, which I'm sure you've been an employee at one point and you've had to do, you would have been taxed on your wages. If the total PAYG withholding exceeds $26,000, you do need to lodge on a monthly basis. So your GST is probably going to be on a quarterly basis. Your wages reporting, if your PAYG is likely to exceed $26,000, you report on a monthly basis for those activity statements. And if you're paying wages, you'll pay super on the ordinary earnings at 10%, and that's on a quarterly basis. So I've got a slide on super to talk you through that. And it's really important to get familiar with the timing of your tax obligations. So understanding what needs to get lodged and when, what do you need to do in preparation? Is it bookkeeping to get everything reconciled so you can do these lodgements? So speaking with your accountant and getting a bit of a plan around what's going to be due and when is really, really important. Just so you understand what's upcoming and what you need to do in preparation for these lodgements. Budgeting. So this is, a really underutilized tool for people in their first year of business. I won't talk through all this. There's a bit of content there and you can get these slides at the end. But the key is you do need a budget. You can upload the budget into your accounting software and track it. And I think, some key tips would be to use benchmarks as a guide for your budgeting, so that if you're in your first year of business, you might not know what the expenses are going to be. However, you can utilize benchmarks to get an understanding of what the expenses are likely to be, which will help you budget. And yeah, some little tips and tricks is, make sure you're accounting for your tax in your budget. So your withholding tax, your GST, your income tax. For your expense side of things, making sure you've got a bit of a buffer. People are really good at doing a, really blue sky, airy forecast or budget. So making sure that you have a scenario in place for if things don't pan out the way you'd like them to, how's that look? Just so that you're in a position so your business can keep going, you can pay yourself a wage. Last thing you want to do is have your expenses too high, your business sales and marketing isn't going as well as expected, and you're overcapitalized in all your expenses. You might have employed people you shouldn't have yet. And this is where a budget's really effective in having different scenarios to make sure that you're on track. On the advice calls, we get this one a lot. So how much should I pay myself? And the answer is it really depends upon the profitability of the business. And to be clear, if you're a sole trader, you're going to get taxed personally. So there's less you can do for that. The profits are your money. This is more so if you're a company structure, how much should you pay yourself out of the company as a wage potentially? And is there other ways to get the cash out of the company in a tax effective manner? The key trigger is, what is the profitability? And what is the personal income level? What's the taxable income separate to the company? Do you have shares? Do you have other salaries? Like what's your personal situation? What's the company profits? And, we just look at the tax rates across the company and the individual levels. We look at how much you need to get out of the company. You might say, hey, Pat, that sounds fantastic, paying myself 45K salary and some dividends because my profit's 60K, but that might not work if you've got a salary of 100K outside and you're doing this business part-time. So we really need to factor in what's the income for the different entities involved? What's the profitability in the business look like? Will that profitability be maintained? So just because you've got year-to-date profit of X, will you continue to have that profitability? You're looking at buying assets. What's the business position?
I think this is
likely
also really
to be
important about getting in touch with you before the end of financial year, because it's also about the money flow. So if you want to pay yourself a director fee or a salary, you've got to do it on this side of 1st of July.
Sure.
And if you want to pay, and so if you don't, then when it comes time for the accountant to do the numbers in October, if the money actually hasn't gone out, then you're not going to be able to record that as a director's fee.
Yeah.
But if you've paid it out on that side, you can record it in accounting purposes, whether it's a director's fee or a dividend, for instance, if it's the same entity.
Yeah, correct. So really important that if you've got trading history in the business, it makes it a lot easier because then we can look at prior months and look at averages and look at trends, fluctuations. Maybe you have really busy December and January because you're in retail, or maybe the opposite, you're in professional services and it dips. And so, yeah, really important to speak to us to get an understanding. There's not a one size fits all, although we do have some strategies depending on profitability. So the size of the profits can dictate, if there's $1 million profit as an example, then we've got the 180K salary where it changes to 47%. So we might be trying to utilize those 180K caps. So what we try to do is we look at the profitability, we look at the individual tax rates, we look at the taxable income, and we try and devise a strategy to get it out in the most tax efficient manner. And that might be some directive fees, some wages, and a combination of dividends as well. Won't spend much time on this record keeping. It's important to know you should keep your records for a period of 5 years. Accounting software is great for that. We'll touch on it in a little bit. The benefits are really obvious, right? Having good record keeping, your financial position, your budget will be more accurate. You can use the data to make decisions. You'll meet your tax obligations on time. So this one's common sense.
If you ever need a lawyer, you've got something well structured and organized, and you can calculate the loss and damage quite easily.
Yeah, that's right. And you can just plan better. You understand what your upcoming expenses look like, your upcoming obligations, and you can just be in a better position to better utilize the cash in your business to grow your business and put yourself in a better position. So, running a business, one of the key is, managing your cash flow, and how you spend your money determines, how good your business is going to be. If you've got really up-to-date live reporting and good record keeping, and you've got good data to use, you're going to be in a much better position to make the right decisions. Few little quick ones, bookkeeping, so accounts payable. It's good to set it up right from the start, and it's good to send your purchase invoices and tax receipts into the accounting software. The benefit to this is it saves against a bank transaction, and then you can drill down into that transaction and see, oh, that was for that invoice, that was for this. So in the future, if the ATO ever audits you, you've got that record saved in your accounting software, and you don't have it in your emails or in paper file, right? So there's some really good softwares for this. There's functions inbuilt into nearly all the softwares, but there's also some add-on softwares that can do it, like Dex and HubDoc and a few other softwares. Invoicing and accounts receivable, set up automatic reminders is really important so that you've kind of got a debt collection happening automatically. Set up the process for it. So if invoices do become overdue, what's your process for it? How are you following it up? Is it systemized? Do you have a process in place? Do you get on the phones and call them? At what point do you do that? So it's just important to have your automatic follow-up emails going from the software, which is fantastic. And then also having a system in place to call. And there's some legal aspects which Damin could help with around recovery if they're not playing ball, and letters of demand. And there's a few different
that's right.
things you could do.
Yeah. And there's things that you can do yourself. NCAT, VCAT, QCAT, all the tribunals for small claims, you can do it yourself. It's made for individuals to do it themselves. There's video tutorials on their websites to show you how to do it. And it's quite informal. It's not a mahogany wood court-like venue. It's actually a normal government building, I guess, venue. And it's less intimidating. And you can chase your own debts.
Excellent. Consider taking payment, a part payment or in full, to de-risk cash flow strain. First couple of years in business, anyone will attest, cash flow is king. It really is. And, those late payments can really kill your cash flow and put you in a world of stress. So that's just one thing you can do. You can do a deposit, you can do an upfront payment. It depends on the service and the type of business that you're operating in. And there's other legal considerations to think about. Do you need to hold the money on trust? How's that work? So
also just payment terms. A lot of people put 30 days from the end of the month, and that could be literally 60 days.
Yeah.
And it doesn't make sense.
Yeah.
There's no requirement for you to give anyone 30 days to pay your invoices.
Right. Short as possible.
Any technology
ideally.
makes you pay on them immediately. It's only when you're getting into big blue chip companies or government where you're looking at 45, 90-day terms. But normally 14 days is quite reasonable.
Yeah, I
Or
think
even
14 days
7.
is good.
You can do 7 if you're continuing service. So you want to think if you're going to be doing a bunch of invoices and your invoice terms is 30 days, that means you're not going to find out until another 30 days that your last invoice didn't get paid. So now you're 2 months unpaid.
Yeah.
So if you're doing progressive work, you probably want it 7 days so that you know within 7 days that they haven't paid, and then you can suspend your services.
Yeah.
Otherwise, you could end up doing a lot of work.
You pay for the service and don't get paid. And a really simple one is to have the card, the online payment gateway linked to the invoice so people can pay by card online. So that's it's really important if you're just sending an invoice and it's got bank transfer details. Doesn't give the customer many options. So if you are sending invoices and you're not a point of sale, they do charge a transaction fee. So obviously, if you're dealing with not many clients and they're fine to do bank transfers and it's really easy, then fine, that's the best, because then you're not losing the transaction fee. But it does make sense to offer flexible payment options for your clients so you can get paid faster.
Which allows for credit card as well.
Yeah.
A lot of companies like using credit cards because they earn a lot of points. They have other benefits as well. Yeah,
it's just much faster these days. And bookkeeping, just bank reconciliations, I'll just be really quick on this. You can auto-categorize the transactions if you set up rules. So as an example, if it's a bank fee, the description says, bank charge, bank fee, you can set up a rule so it automatically recognizes that. If you set up your accounts payable correctly and you're sending your purchase invoices and your purchase receipts into the software, it will automatically recognize match to those transactions. So you can dramatically speed up your bookkeeping if you set it up right from the start. Setting up an employee, there's a few steps to follow. I won't go into much detail because we're running out of time, but this slide's here. The key is making sure that you set up the number of hours correctly. We see this all the time, that they accrue leave at one rate and then they deduct it at a different rate. So just make sure you've got the 7.6 to 38-hour working week or the 8 hours, 40 days set up in your system that's consistent with taking leave. And ensure with the superannuation, I've got a slide on this. It's important. You need to do it through a superannuation clearinghouse now, where you pay once and then they pay all your employees for you. And also, if they come to you and they don't have a super fund, they've just changed the laws on this, where you do need to lodge a form now and try find their fund for a stapled. It's called a stapled fund. So the government has a link to this. You can, you used to just have a default fund you can create for them, and you had to do it within a certain time frame. Now you actually have to find their super fund that they have, so that they don't end up with multiple super funds with low balances getting chewed up. So it's a good initiative. It doesn't take too much longer, but it's important to know that you do need to follow this if you get a new employee and they don't provide a superannuation fund. I won't talk too much about this. That's what I just went through, but it's important to note you do need to pay super on all your wages now. It used to be there was a $450 minimum, and they got rid of it. So if it's if you're paying someone $200 for the month in a wage, you do still need to withhold super. I've shared a link to the ATO for the stapled funds as well, if you want to have a look at that. And ongoing reporting, this one's really valuable. So setting up your reports right and looking at what do you want to track moving forward. It's really critical that if you do set up your accounting system in a really good way and you have really sound reporting, you'll be able to, you can add your budgets into the accounting software. You can track how you're going. You can create some really good reports to see where your business is positioned. You can use benchmark data to see, are your percentages in line with the benchmarks? Or, are they in line with your growth strategies? Are you spending too much on sales and marketing? Are you spending too little? Is your rent in line with sort of the area per square meter? So there's all these insights you can get out of having the right reporting
And
setup.
even like for a law firm, for instance, we find forecasting so important for us because we know that March, April are very busy months.
Yep.
June is the busiest. November, December is busy. July is normally slow. January is dead. But we got to pay the same amount of wages and fixed costs month to month.
Sure.
So we need to know that we can't pay ourselves a huge Christmas bonus and clear the bank accounts because in January, we're not going to cover overheads potentially. So yeah, forecasting is really important, and having that cash flow forecasting is really important.
Yeah, it's critical, and you get better as you go. And it's just like it's really about habits. So you create these good habits up front. You need to invest some time into these things because they are really important. Like the clients that we speak to that, you know, their records are a mess, their books are a mess. They don't know what's going on. They're behind on things. It's because they didn't set up the processes up front. They didn't invest any time into it. They didn't speak to accountants and lawyers, and they just kind of winged it. They parked it. They put it as not important. And ultimately, they're paying the price for doing that. So it's important to
I heard
set it
someone
up.
tell me once, it was your business is like a wheel. And I've told this story many times, but your business is like a wheel. You're doing the sales, and then you're winning the work, and then you're doing the work, and then you're invoicing the work, and then you're chasing the debts, and then you're winning the work again, and then you're doing your marketing, and then and slowly but surely you've got to take one of those hats off.
Yeah.
And the very first thing that you need to take your hat off is for your bookkeeping and your accounting. That's the last thing that you should really be doing. And you should be putting it in the hands of a bookkeeper or an accountant to save up your time, because it can be quite time consuming.
Yeah.
And you can spend that time on making money rather than reconciling your accounts that only accountants like to do.
Yeah, it's not an enjoyable job for most, but luckily for you guys, for us, it is. And yeah, like where you focus your time and energy is what results you're going to get out. And whilst you do need to, I always say, try it and do it initially so you get an understanding of it and you understand the work that goes into it, the time that goes into it. You get a bit of a feel for the accounts, what's important, what are you looking at. So I do think it's critical that you do sort of gain some understanding of it. But as Damin said, yeah, you as a business owner, you should be heavily involved in the marketing of the business, the sales of your business, and the product of your business. So the delivery of the service or the product, really critical. And looking at the strategy, you should be just really laser focused on the business strategy, the business direction, and the tasks that are, you know, less technical and repetitive and zap a lot of your time, you should be spending less time on. So there's a few things here, I won't go into them, but in detail. A few key things are making sure you've got a website, making sure you've got Google My Business set up, making sure you're getting reviews on Google My Business of clients. It's really critical. Like we win a ton of work by having really good Google reviews and people, you know, and real genuine ones. Make sure they say the name of the person that they were dealing with. But it definitely helps, and people mention it. People even request, can I speak with X accountant, because they've seen these reviews and they've seen they're doing a fantastic job. So it's really good market recognition. There's a few things in here. There's free online directories you can use. Really understanding who your ideal customer is critical, which can form part of your marketing plan. Strategic partnership opportunities, like we work closely with Lawpath, and it's been fantastic for us. We've been able to help, you know, hundreds, if not thousands of business owners by working with Lawpath and vice versa. So
I think that's another thing that's really important, is that you realize that associations and referral networks are really important for your business. You either have to find each one of your customers by spending money on marketing, or you can find one client that gives you a lot of referrals.
Yeah,
and
so
it
true.
just makes such a big difference to your business.
Yeah, we've done it all. We've done the SEO, the SEM. We've done, you know, so many different strategies. We've got videos on YouTube which get a few leads in. It's expensive. Google Ads is expensive. Sure, it works. It can work great. Facebook can work fantastic. They can all work really well. But nothing's going to give you the growth as building out a really strong network pipeline and having really good, you know,
referrals. So which businesses are dealing with your ideal target market, and how do you create a win-win scenario where you can collaborate and work together?
All right, we've got to get into the questions.
Sure.
Get Tom back.